Well, good afternoon. Happy Friday. Mark Milam here, your mortgage professional. It's June 28th. It's the end of Q2. We're midway point through the financial year and the calendar year. Let's talk a little bit about the slew of data that we've gotten this week and what it points to for Q3 and Q4 of 2024. I'm going to flip the screen around here, but first I want to talk about the report we got this morning at 8:30 a.m. Eastern Time was personal consumption expenditures. This is the Fed's favorite measure of inflation. It was widely projected that it was going to show 0.0% growth month over month for the overall number, and that's exactly what happened. That puts us at an annual increase or a rise of 2.6% for 1 year. So if we go back a year ago from May of 2023 to this point here in 2024, inflation rising at about 2.6%. That's the lowest level since March of 2021. So we haven't seen levels this low in terms of the growth rate of inflation for 3 years. That's good. That's exactly what we want to see. We need inflation to start with a 2, to have a 2 handle on it, and that's exactly where we are. Is that enough to convince the Fed to cut rates in July? Probably not. We probably need to get another month or 2 under our belt, but we've got our eye on the September Fed meeting in hopes that we might see our first cut of this new cycle for the Fed in September. If we don't get it there, obviously, we're going to push past the election and perhaps we'll get it in December. Let's take a look at a little bit more of the data as we go here. So this is the mortgage-backed securities market. A little bit of a sell-off today, and that's kind of peculiar that we would have a sell-off when we got that good personal consumption expenditures month-over-month reading. Why does that happen? Well, we're at the month end. We're also at the quarter end. That causes a lot of volatility within the trading of the bond market. Perhaps that's got something to do with it. Maybe it's no coincidence that last night was the presidential debate. That had a lot of volatility associated with it. There's some people, some pundits who are suggesting that maybe part of the sell-off has to do with the fact of how that race is shaping up. I kind of don't buy that because neither candidate has a very clear direction in terms of how they're going to reduce the deficit or rein in spending. It's really just about either reducing taxes or spending more, depending on which side of the aisle that you're on. So I kind of doubt that the election has much to do with what we're seeing in the bond market today, but it is yet another factor drawing in some volatility. Really, when we start talking about the deficit, perhaps that's the biggest element that's going to prevent a return to lower rates. Maybe it's not so much inflation, and this is because of our deficit. The national deficit now, the national debt, is rising by $1 trillion every 100 days. You know, sooner or later, that tends to add up, and the only way that the government can fund that deficit is by selling more treasuries, which puts upward pressure on all interest rates. We're collecting about 75% of what the government needs to function through taxes, the other 25% coming from the auctioning off of our debt. And lots of interesting things here playing out with the Japanese yen. Japan is the largest holder, the largest foreign entity holder of our debt. They hold over $1 trillion worth of that, much larger than China. So as we see Japan potentially starting to divest themselves of some of the U.S. debt, we know China is already doing that. Our own Federal Reserve is doing that. So ultimately, we just have too much supply and no real clear path on how we're going to have less supply. That's going to keep a little more upward pressure on interest rates, unfortunately. What else is happening? Well, we can see this report coming out from the National Association of Realtors here that pending home sales slipped 2.1% in May. That follows a dip of 7.7% in April. We're just starting to see the housing market cool off a little bit. Home prices still remaining elevated. The Case-Shiller Home Price Index showed a 6.3% year-over-year increase. National average here in Atlanta, that was about 5.85%. Still, though, we're still seeing nice appreciation. We just are starting to see the market slow down a little bit. Maybe this is around consumers that have just reached their max price point or max threshold for payments, and we're starting to see homes sit a little bit longer. It'll be interesting to see how that plays out as we move into Q3. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.